Hi, I'm Doug Draper with Acme Distribution and the Denver Transportation Club, and I'd like to welcome you to the Supply Chain Logistics, the Storytellers. The series is brought to you by CAP Logistics, and CAP are experts in offering you customized transportation solutions for all of your needs. So please visit caplogistics.com today. So today's topic I'm real excited about. It's very relevant to what's going on. We're going to talk about Chinese tariffs and some of the trade agreements that are going on. And we have our resident expert, Bonnie Shields with CAP Logistics. So Bonnie, thank you.
Yeah, thanks for having me.
It's great to have you in here. You have a wealth of knowledge related to this topic, so I'm glad you could fit us in here and talk a little bit so quickly this week. So before we jump in, I know we've had you on the show before and you've been a great guest, but just do a recap for our audience a little bit about yourself, if you don't mind.
Oh, sure. I guess I have a broad experience in that I've been able to, in the supply chain industry, be both the customer as well as a forwarder and a licensed broker. So I've spent some time over in China looking and setting up global distribution supply chains and working with manufacturers. So across the board, I've got a lot of experiences, and from that, it's allowed me to have some really good ideas as to what really optimizes a supply chain, and I'm pretty passionate about it. So yeah.
Cool, I appreciate that. So let's kind of jump into it. I know it's been a whirlwind week with a lot of changes that's been happening. So with the tariff and the trade war and the next saga that we're in right now, let's take a step back and kind of talk about the history or the timeline of when all the trade tariffs and the quote-unquote trade war started back really third and fourth quarter of last year. So maybe let's just reset the stage for our audience and rewind to the beginning and just hit some bullet points about what's happened and kind of where we are right now.
Yeah, you bet. You know, it's interesting because so far the trade war kind of gets all lumped in together, and there's actually so far two very distinct type of tariffs that are at play right now. It started actually with Section 232, which is something that was not just between the U.S. and China, but between U.S. and most other countries, actually, and those were tariffs that were placed on steel and aluminum. Okay. So that started in June 1st of 2018. And then what you saw is what most people are talking about today, because it's continuously in flux, and that's the Section 301 tariffs. And that is indeed the tariffs that are directly between U.S. and China, and what's described, they came into play because our current administration felt that China is negatively impacting U.S. companies with respect to IP infringement and just lack of enforcement, as well as subsidies to their own companies in order to facilitate trade. So that's the Section 301 tariffs. And the first list of those tariff increases was at 25%, and that constituted about $34 billion worth of trade, and that went into effect on July 6th, 2018. The second list then came into place and became effective August 23rd of 2018. That was about $16 billion more dollars impacted, and also at 25%. Then what you had is a third list that came out in September 24th of last year, and that rolled in only at a 10% tariff, and so that impacted about $200 billion worth of additional goods. And so what you have now most recently is an increase to that third list.
Got it. So let's talk about the tariff increase, just to make sure I understand this correctly, and our audience as well. So when they say a 25% tariff, that is on top of the existing duty rate. Is that correct, or is it just flat 25? So
no,
if
absolutely.
I imported a shirt, for easy math, this shirt has a 10% duty rate. The 25% is on top of that. Is that correct?
That is correct. So in your example, you're exactly spot on. These additional tariffs are ad valorem tariffs. And so you're just right. It's a compounded duty rate or tariff that is on top of the standard duty that is normally paid to customs at the time of importation.
Gotcha. Yeah. So in the example we're talking about now, this shirt would now have a 35% duty rate.
Correct.
Okay, good. The other question that's come up a lot is, when does that happen? I know it was announced on the dates that you spoke about, August 23rd and September 24th. So the shirt is still over in China. Is it when it sails? Do I still have the old duty rate? Is it whenever it's cleared in customs? Like, what is the exact time that extra 25% is applied?
So that was a significant difference in the announcement that just happened on May 10th. So on May 10th, that third list that was at 10% will now go up to 25%. So any existing lists that are out there are all now at that 25% additional tariff. And the difference this time around, though, is there is a little bit of a gap. So any items exported on or after May 10th that enter the United States commerce or enter after June 1st will be hit with this. However, there's that little bit of wiggle room where if it exported on May 9th and will actually get here before May 31st, you're still at your 10% additional duty. So if you had something that maybe left on air freight on the 8th or the 9th, and it'll get here sometime this week, which is well before May 31st, you're still getting rated at that 10% rate. But anything that had an export date of on May 10th or will come in after May 31st will get hit at the 25% level.
Gotcha. So it's upon entry, basically, is what you're saying.
There are two dates, both the export date as well as the entry date right now. There's kind of, which makes it interesting because on the prior implementations, it was upon entry and effective immediately.
Immediately, yeah, that's what I thought.
And so this one gave you a little bit of wiggle room for those things that are happening within that left before the 10th and will arrive before the end of the month.
Huh. Any reason why they changed it? Or
no explanation on that, yeah.
No explanation on the first time they did it either, right?
Exactly.
That's crazy. So here we sit. What are you hearing from the China response? And I know that we were prepping for the show, and it's changed just in a couple times that we've been talking. So what are your thoughts on what China's doing to react to that the war, if you will? Yeah,
and it's interesting because you'll hear through the media within the United States, you'll hear that there are retaliatory tariffs that they're putting in place. And so that did happen. And China, however, communicates it throughout their country as reciprocal tariffs, although it certainly wasn't at the volumes that we did here in the U.S. So they have about $60 billion worth of U.S. goods that will be impacted as a result. In addition, some of the, I guess, significant factors that came as a result of everything, I'll start on the U.S. side and then kind of go back over to the China developments. On the United States side, politically, there is a legitimate concern of the huge financial impact that China's subsidies and IP infringement causes U.S. customers. So Trump took this hard stand, and his supporters love it. So that's what's happening politically. As an economist, I like to believe that government intervention is really not needed, that these companies, U.S. companies, have a choice as to where they want to manufacture, and if the benefits of manufacturing elsewhere outweigh the risks or the loss that they incurred by manufacturing in China, then they would choose to do so. So that's my own kind of personal opinion there. And when left untouched, that global markets are just going to fix themselves. U.S. consumers are largely the ones getting hit in this. So Deutsche Bank chief economist Michael Spencer is quoted saying that the conclusion so far is 100% that U.S. customers are bearing the cost of this, not just with respect to higher prices when they go to purchase, but also at potential taxes as a result of having to offset the U.S. subsidies that are now being paid to farmers that are being impacted negatively by these tariffs. So a couple of different ways that our U.S. markets are being hit. Just kind of another personal opinion, I guess I'll put out there, is that the declining markets that we did see shortly after these announcements, then what you saw, as well as some grumblings from those farm-dominant states. You saw some tweets by our current administrator that they're hoping that they can kind of resolve these issues with China, maybe even potentially within the next couple of weeks, and try to kind of soften the volatility and kind of dial that back a little bit. So, so that's what's, I guess, significantly happening in our marketplace. Going back to China's response, they are actually using the media to tell a little bit of a different story internally. So inside of China, you have all of our, all of the new company owners and manufacturers that want to open the markets, do business easier globally. And they have their own internal battle with those longtime hardliners who, are the old school. We want to make China great. We're only going to focus on China and what their needs are. And unfortunately, right now, that's who's in power within China. So that administration then within China is sending out information via the media, that says that they're kind of more of a victim in this. And so we'll have to see how that plays out.
Interesting.
Yeah.
Yeah. Well, one thing about the tariffs I wanted to touch base is that this latest round, do you think it's hitting the pocketbook more directly? And the way, let me rephrase that. So the first tariff was, hey, I'm getting hit with 25% on steel. Well, as a consumer, I'm not buying steel. It's a material that's used to make something that I might buy, or even make something that makes something that I might buy. So my direct impact is 2 or 3 levels beyond, right, that I may not see it. But these latest rounds, it's really things where my purchase power goes directly to the final import, if that's the right way to refer to it. Do you see that these tariffs are impacting consumers in that way more? Where, hey, it's 25% on a shirt, where 6 months ago it was 25% on a board of steel. Well, I don't buy steel. It may turn into a pen that I buy. So my question is this last round more hitting the pocketbook of the consumer more than the first several rounds?
Yeah, great question. You're right. So
it's kind of a confusing question, so I'm glad that you understood it.
Yeah, absolutely. So you're right. When it came to steel and aluminum, companies are the ones that buy that and then manufacture a product. So those companies, I think one of the main people that spoke out at that time was actually Harley Davidson. So they came to the plate and they said, our costs are rising in order for us to manufacture here within the United States as a result of this, but we don't want to raise prices to our consumers, so we're going to try everything we can to absorb this. I think that was kind of round one. Then as the volatility continued and you had your second list, what you started seeing in that second list was more parts and components. So now all of a sudden it was like sub-assemblies and things also that go into maybe a final finished product, but starting to hit then a few more of your manufacturers that maybe buy components and then just sort of assemble here for sale here in the United States. Then as you transitioned into list 3, you're starting to get to some more of those finished goods, washing machines, dryers, things like that. And so obviously that's going to get passed on to the everyday consumer. And then what you're looking at moving forward, there's a potential 4th list that's actually now floating out there, and that really does go to more of your mainstream retail items like clothing and things that we would just buy off the shelf. Yeah,
that's a good point, because I think that you hear about it in the news, but you don't really understand how that impacts you and your bottom line when you're sitting there shopping at a store or a retail front. Do you think the fact that it's hitting the pocketbook, this last list 3 and potentially list 4, do you think it's going to change the response from Americans at all?
It still might be a little bit out a few months, because you've got to wait for all those goods to come in and then for those prices to actually go up. But consumers are definitely starting to feel it. And I think the more that media, folks and experts in the field from Deutsche Bank and other large organizations come out and say, well, statistically, what we're seeing and what's happening is that, yes, indeed, U.S. consumers are the ones that are getting pinched here. You're going to have a little bit more, perhaps, people not liking these tariffs and the trade war continuing. From the farmers directly, they're starting to get a lot of pushback because they're really starting to hurt, because when China then puts in their reciprocal tariffs, a lot of that is against the fruits and vegetables and things that we would export over to them. And so those farmers now have just lost a large buyer of their products, which, obviously, they want to be able to sell those goods for U.S. consumers. Those are some of the things that we've actually benefited from. So I remember last year being able to buy, pounds of cherries for half the cost of what I did in previous years, because that produce then is staying here local. And so we as consumers had some benefits in some industries, although we're feeling the pinch quite a bit in others.
Right. So what are some suggestions on, how companies could deal with it? And I'll ask my question a little bit differently. you were on with us right when this really transpired in the second and third quarter of last year, and one of the topics was, what are some alternative strategies, right? And do you think that customers and clients out there actually looked at other sourcing strategies, or kind of said, you know what, this will pass, I'm not really going to do any research about how to protect myself in the future? So my question to you is really twofold. One, in your experiences with your customers, have you seen them reach out to you or Cap Logistics about, I need to come up with another option? And then number two, kind of restate to the audience kind of what are some of those options out there so they don't get burned by list 4 or 5 or subsequents.
So a lot of our headquarters for Cap Worldwide and Cap Logistics is here in Denver, Colorado. So a lot of our customers are here local to that area. So we do see that costs are obviously rising for those China imports. And as an active freight forwarder and customs broker, several of our customers have come to us and said, hey, what can we possibly do? They've had to place their purchase orders, unfortunately, 6, 9, sometimes even 12 months out in advance. And so therefore, companies are starting to feel that pinch where they're stuck right now because those purchase orders, they've already put money down. Those purchase orders have to now flow in, and they're just going to have to pay that amount. So if they had a fixed budget and they didn't really anticipate those increased costs, their return on investment and what their projected margins on that now are obviously going to be hit moving forward. But a lot of Colorado companies, they just can't sit by anymore. They were waiting. They thought, well, maybe this will end quickly. Yeah. It's proving not to end so quickly and to remain very volatile. So now they're starting to have to get engaged and just take control of their supply chain. So.
Interesting.
Absolutely.
Yeah. So what type of strategies are you seeing out there that companies are doing? We've talked about nearshoring, going into Mexico and Central American type of companies. Can you give us any examples of what clients what are people doing differently so they're not getting burned, if you will?
Well, people are starting to look outside of Asia to source, and so where possible, Mexico is a great place to look. They've got strong manufacturing capabilities, a great and improved infrastructure. They've obviously got lower transportation costs because they're just across the border, and so you're looking at a ground transportation. And it's also a much shorter than asset carrying cost because your supply chain itself will reduce down. So Mexico is a great place to start to look if you need help in possibly researching that and you're a little timid about going into the Mexican market. Cap Worldwide has resources that can help you with that. So that's one suggestion. I've also felt a lot of companies are starting to do what they call purchase now domestically, which is an interesting option because even though you're purchasing domestically, many of those items are still being manufactured overseas and imported, so you're still looking at really a higher cost to secure those items. And so I've had a lot of people ask me to really differentiate for them, what does buying domestically mean? And tariffs themselves are on the country of manufacture. So if you buy domestically and they imported it from China but now are just reselling it because maybe that manufacturing company has a U.S. entity as well, you're going to see those increased costs in those piece prices. If you actually go to maybe another country, maybe you go to Mexico to source this product, but ultimately Mexico is also a reseller or doing very minimal enhancements to the goods, the true country of origin still remains as China. And if that is indeed the case, you're still going to be hit with those additional tariffs as a result. So it's important that as you branch out in your sourcing strategy, that you're just aware of those situations and asking those questions before you just dive in.
Right.
So there's some of the things that I'm seeing.
Interesting. What about foreign trade zones and those type of things that we have a couple here in Colorado, but I know that's a big deal where you can bring product in duty free because it hasn't entered commerce yet, and you can do some manipulation like you had seen. Are you seeing companies, or has that concept gained any momentum? Or give us your thoughts on free trade zones as a solution, or foreign trade zones, excuse me.
Yeah, you bet. When it's the right solution, it can be a great solution. So if as a U.S. company, perhaps you have manipulation that takes place, and then you're going to export some of your goods up to Canada or down to Mexico or to other countries, that's a great way to utilize a free trade zone, because you end up not having to prepay imported duty, and then you're just going to turn on and export something out. So that's a great way to utilize those.
Right.
The benefits of that are usually for your much larger importers, so it's not an option that is a viable option, I think, for your medium or certainly your small importers.
Right.
So, yeah.
It's out there, but you have to be of some...
It's the right situation.
Some scale. I completely understand that. So what do you think is going to happen next, right? We talked, this is the second time you've been in 9 months, and we're at list 4.
Right, yeah.
Hopefully we're not at list 11 here in the future, but what's your general thoughts about what's going to be happening later this year?
Well, right now we've got guarantee of the change of the implementation of list 3. So there is a list 4 that has been created. It's not in place right now. It would not do a 10% and then a 25%. It's being predicted to be just coming in right at the 25%.
Right.
Right now it's pending for a possible implementation in June, but given the volatility that could come in or push out, I think, as we all follow the storyline. So again, and this is a list that's going to hit the more of the retail, our direct purchasing type of items. In addition, something to note is also on May 10th, it was also just announced that our U.S. administration has put out a list that's going to impact some aircraft parts that are coming from the EU. So this isn't just going to be potentially a China situation. Now we're looking at expanding it to aircraft parts from the EU. So that's coming down the pipe.
Interesting.
Yeah.
Say that again. All right. What you just clarify that one more time. You're saying that's on the list that just came out on May 10th is not specific to Chinese imports. It's starting to overlap. Yeah.
So again, the whole idea behind Section 301 tariffs is that it's a tool that's being wielded because we feel that other countries are negatively impacting U.S. companies with respect to IP infringement or subsidies within their own countries. And so when it comes to this potential list of aircraft parts coming from the EU, the direct correlation there is with subsidies that have been provided to Airbus. And so that places then U.S. companies at, hinders their ability to be able to compete in that space. And so that's the response for that.
Okay. So it's important to understand the context of what we're talking about. It's not specific to China. It's protecting the interest of the U.S. And China is the low-hanging fruit or the group that gets the most attention. But this is protecting the U.S., not necessarily penalizing China.
Absolutely. Yeah, gotcha. That is the goal.
Yeah, absolutely. So I know we spoke a little bit about strategies, and we just have another couple minutes here. But what suggestions would you have for our audience to, protect their supply chain moving forward?
Yeah, you bet. So the first, of course, is to start looking at sourcing outside of China directly, and all of North America is a great place to go. Another really great option would be India. So I'd start to look at that. The second option is to really understand your supply chain as a whole. Start to look into the impact of what IMO 2020 regulation means to you. It's also going to hit the supply chain as a whole, and it's a rising cost of ocean costs that you're going to start to see in Q4 of this year, and by up to about $250 per container. And then going into 2020, you're looking at maybe about $600 to $650 per container in terms of those increased costs. So if you're starting to budget now for next year, you've got to take into consideration not just tariffs, but also new regulations going to hit your ocean costs.
Right. And the IMO, for our audience real quickly, is basically emissions, right? It's regulating the emissions of the steamship line.
Correct. It's a requirement starting in January of 2020 to go to a low sulfur fuel.
Got it. Okay.
And the third option is you've really got to start to invest in your supply chain technology. So it's amazing how many multi-million-dollar companies I go into, and they're still doing demand planning on a robust Excel spreadsheet.
Yeah.
It works. But really what you're going to have to do is you're going to have to start investing in technology and start to have real-time data. You're going to need the ability to, change those data elements on the fly, as well as have increased models that take into account these quick changes of tariffs or costs within ocean rates, and just be able to allow you opportunities to flex when needed.
Yeah.
And Cap Worldwide can help with those options.
Yeah, great. Well, data is power.
Exactly.
Right. Harness it and use the technology to make wiser decisions.
That's right.
So, well, great. Well, we'll leave it at that for today. I really appreciate you joining us, Bonnie. You've been excellent. And if anybody has any questions further, they can reach you at Cap Logistics, correct?
Absolutely.
Awesome.
Look forward to it.
Good deal. Well, thank you for joining us today on the Connect and Collaborate Network featuring supply chain and logistics, the Storytellers. We've had a phenomenal one here today. So, again, thank you, Bonnie. And thank you all for listening.